Welcome to This Explainer. Today, we are demystifying a milestone that literally paralyzes so many beginners: exactly how to take your very first $1,000 and strategically enter the stock market. Whether you've scraped together your first $100 or the full $1,000, getting started can feel totally overwhelming. But hey, it doesn't have to be. Let's dive right in and map out exactly how to take this journey.
Right out of the gate, we're faced with the million-dollar question. With that first $1,000, do you put it all on one great company, or do you spread it out and diversify? Is $1,000 even enough to worry about diversification? Well, the honest answer is that it completely depends on what you're trying to achieve and, more importantly, your personal risk tolerance. Let's break down exactly what that actually means.
See, before you buy anything, you have to decide your risk tolerance. On one side, we have concentration. Going all in on a single stock is basically a go big or go home strategy. You can dramatically multiply your money if things go exactly right, but you could also lose a massive chunk of it if they don't. On the flip side, we have diversification. Spreading your money across hundreds of stocks is significantly less risky. It protects you from those devastating losses, but the trade-off here is that you won't dramatically outperform the overall market.
Section 1. The diversification illusion.
So imagine you own these 7 stocks: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and Tesla. Now, a lot of people would look at this list and think, wow, I own 7 different companies. I'm incredibly diversified. But are you? Just look at what these companies have in common. They are all massive U.S. tech companies. They're heavily influenced by the exact same economic conditions, and they ride the exact same market trends. Basically, they share the exact same risks.
You see, true diversification isn't simply about the sheer number of stocks you own. It's actually about reducing risk by owning investments that do not all move for the exact same reason. You want a portfolio where, if a specific economic event happens, it doesn't just wipe out every single company you own all at once.
Section 2. The emotion of investing.
Believe it or not, one of the biggest hazards for a new investor isn't necessarily picking the wrong stock. It's actually the emotional reaction when an investment declines. Just imagine, you put your entire $1,000 into one single company. A few months later, they release a disappointing earnings report, and boom, the stock rapidly drops 30%. Suddenly, you're staring at this number, $700. Your hard-earned $1,000 just shrank overnight. Ouch, that hurts.
So, the crucial question here is, how do you react in that exact moment? Would you calmly hold your investment, or would you panic sell? Investing isn't just about the math. It's heavily tied to our emotions. It is completely normal to discover that you have a much lower tolerance for risk when your actual, real-world money is on the line. Experienced investors will tell you that managing this psychological pressure is absolutely half the battle.
Section 3. The variety pack solution.
Because picking a single home run stock is so stressful and risky, index funds and ETFs have become incredibly popular. When you buy an S&P 500 ETF, you aren't just buying one stock. You're actually buying a tiny ownership stake in approximately 500 of the largest publicly traded companies in the United States all at once. Think of it like a giant variety pack. Notice how tiny the slice is for a single company compared to the massive S&P 500 basket as a whole? Your fate is no longer tied to just one piece of the pie. If one single company in this basket struggles, another company might perform exceptionally well and completely counterbalance it. You're essentially just investing in the overall market.
But hey, we have to be honest here. Diversification is not free. It comes with a cost, and that cost is reduced potential gains. Think about it. If you put your entire $1,000 into a single stock and it doubles, your returns are extraordinary. But if you're heavily diversified, and that same stock only represents 2% of your portfolio, meaning you only have $20 invested in it, then even if that stock doubles in value, it's not going to be a huge, life-changing win for your overall account. So while diversification massively reduces your risk, it definitely caps your explosive upside.
Section 4. Taking action with VOO. If you're inexperienced, keeping things simple is a huge competitive advantage. A highly effective strategy is just investing in a low-cost S&P 500 ETF. Now, you might hear people debate between Vanguard's VOO and SPY. Listen, both of these track the exact same 500 massive U.S. companies. You're buying the exact same underlying assets. However, VO is an excellent choice for one very specific reason: its remarkably low expense ratio.
VOO has an expense ratio of just 0.03%. But what does that actually mean for you in plain English? It means that for every $1,000 you invest in this fund, they're only going to charge you a tiny fee of 30 cents per year. That is literally less than a single pack of gum to manage your wealth for a whole year. It's incredibly efficient, which allows your money to actually stay in the market rather than being eaten up by management fees.
Okay, let's see how this builds into an actual transaction. Currently, one share of VOO costs just under $700. So if you have your $1,000 ready, step one is to buy that single share. That leaves you with $300 left over. So what do you do with it? Well, you have two great options. Step two, you can simply hold on to that $300, save up another $400, and buy a second full share later. Or step three, many modern brokerage accounts actually allow you to buy fractional shares. This means you can take that remaining $300 and immediately buy a fraction of a VOO share, getting every single dollar working in the market right away.
Section 5. Building wealth through habits.
You know, people often feel kind of embarrassed to start if they only have $1,000, or maybe even just $100. They think it's not enough to really make a difference. But starting with a smaller amount is actually a huge strategic advantage. Why? Because every single successful investor has made mistakes. It is vastly better to learn those harsh emotional lessons, test out your risk tolerance, and make your beginner mistakes when you only have a smaller quantity of money on the line, rather than waiting until you have a massive lump sum to lose.
As this quote perfectly captures, the first $1,000 you invest will most likely not make you wealthy. What will make you wealthy is the habits. Getting started today, contributing money to your account on a regular, consistent basis, and patiently letting it compound over time, that is how real wealth is generated. Your first $1,000 is simply the tuition you pay to build a lifelong habit. So take a look at your bank account today. Are you going to keep waiting for the perfect moment, or are you ready to buy your first wealth-building habit right now?